Well, hi there. I've got a little bit lost, so it looks, Stuart, like you might be doing the webinar today. I'm Alec Hogg. I'm in Cape Town. I'm in a home suite, which is really quite amazing. But it looks like the internet connectivity in the very quiet area that I've been sent to could be a bit dodgy. So if I get lost, not to worry, because Stuart is with us in the background. And then I'll switch from the fiber line they've got here, Stu, to my trusty iPhone. I think Vodacom and the iPhone will probably see us through, but let's just see. It seems to be stable now. Do you want to help everybody through the basics of how we conduct this webinar?
Yes, thanks very much, Alec. It's nice to, I'm in your seat today. It's quite different. And hopefully new studios very soon, which we'll show everyone when we're there. Just quickly, if you can hear my voice and see Alec and myself on camera with a presentation front page with the dollar weakness, there's a little high five button on your control panel on the right hand side. If that's all coming through, can you just let us know? Oh, there we go, Alec, I've got a few coming through. Excellent. I know it won't help, but if you can't hear sound, can you just double check your internet connection? Because I do know that is sometimes a problem, or the settings on the control panel themselves. There are options there. As the intro says, we also like to keep it quite conversational. There's little questions drop down on that same control panel. If you put your questions in there, I'll pass them on to Alec as soon as we can. But Alec, all over to you.
Brilliant, thanks, Stu. And well, as you can see from the headlines, it was a story not of Rand strength, and I'm going to show you that in quite a bit of detail in a moment. It was more a story of dollar weakness. And because we are primarily invested in the US stock market, we've got an Aussie share as well, but outside of that, we're primarily in the US stock market. The consequence of that was that we've now dropped below 30% annual compound growth rate in rands to 28.9%, and then actually level pecking pretty much at 23.5% in dollars. But that's just an indication. It's just indicative. It isn't really to say to you that we worry about things month by month. The intention of this is really just to give you some understanding, or just to give you a little bit of an update on a monthly basis what happens. So kind of the idea is this: once you invest in the stocks that we have in the portfolio, we will keep monitoring them. We'll keep looking, well, I'll keep looking at them as I do, because it's the job that I've got. And then if something happens that is fundamentally different and changes the outlook for that company, then we will make a decision on whether to buy or to sell that stock, and indeed to look at new stocks to buy. So if you like, it's a little bit like having your international stockbroker who's having a look at the portfolio for you in an ongoing basis. Well, I'm not international, and I'm certainly not a stockbroker, but I think you get the picture. So we keep watching what's happening in the international markets, and then update this portfolio as a consequence. Right, so that's so much for the background. I want to just make sure that we've got all the tech right on my side. Indeed, it is. It
Sorry,
should
Alec, I
be
think we've
there.
just lost the, oh, there we go. Perfect. Sorry.
There we go.
Back.
There we go. Yeah. Okay. So now it should be, there we go. Absolutely. I've got the right screen open so I can see exactly what you are seeing. And this is in the past months, the performance during February. As you can see, a big pullback by Apple. So it's our second biggest stock in the portfolio, so nearly 12% decline. What happened there was a lot of excitement after the Apple financial results. Indeed, they were record numbers and all looked very well. And we're seeing this increasingly in a bull market. It's buy on rumor, sell on fact. We had a similar story with 2U. That share price went up to $55, but has subsequently come down to 48, but it's still an improvement of nearly 12% on the month. The best performers, though, were the South Africans. Discovery up nearly 16% in the past month. I think this is primarily a result of a very conservative budgeting by Discovery for the pandemic, which is not appearing to be as bad as, or certainly as harmful for the company as was originally anticipated. And then Wilson Bailey, which is lifting its head. Maybe people are now starting to believe that Cyril Ramaphosa has got his handle or his hands on the situation here in South Africa. It's very hard for people to see through the noise, a very noisy country that we stay in. But if there is to be an economic recovery in this country, and clearly you have to have that with the high rate of unemployment, then that's going to come from increasing infrastructure spend. That's been targeted by Ramaphosa, and the economic plan for South Africa is indeed to invest in that area. And anybody who's been driving on our roads, both in the cities and in the rural areas, every road excepting for the toll roads, and there's a very good reason for that, will say this can't come too soon. The potholes are going crazy, and that is a reflection of poor maintenance and indeed the need for infrastructure to be jacked up. So all round, Wilson Bailey has improved nearly 10% in the past month as the concerns about the infrastructure program not being kicked into gear are now going into the background. But that gives you a good understanding of exactly where the moves were in the past months. We bought Xero for the first time last month. This I went into quite a lot of detail, and if you weren't with us in that webinar, I suggest you go and have a look at the either the YouTube video, it's on the Biznews channel, or you can go onto Biznews Premium and go and read the background and outline to it. There were many reasons why we like Xero and continue to like it. I did say to you that our best case scenario would be for the Xero share price to actually stay low, or in fact fall over the next couple of months, because we buy these shares as we do with every purchase, unless in exceptional circumstances, talking about every international purchase, we buy them over a period of 3 months. And the reason for that is to take out the volatile South African rand from the calculations. And the rand itself has been extremely strong in the past month against the US dollar. It hasn't done a heck of a lot against the Aussie dollar, and you'll see that in a moment. But the Aussie dollar has also been strong against the US dollar. So as a consequence of that, in Australian dollars, we are getting more money, or we're having to pay more rather, for our US dollars. On the other hand, the Xero share price has dropped quite significantly in the past month, from $137 to $120. You might remember I said that when we bought it last time, that is possible or probable because there's no news flow until at least about a month and a half from here. Then we'll get the interim results again, and I'm pretty confident that we'll see an uptick in the Xero share price. This is Mr. Market is in a very I suppose you instant gratification mood, where he's watching what comes out in the financial results, gets terribly excited about them, and then the minute there's no news flow, forgets about it. So a lot of retail investors are coming in. Those of you who read my newsletter, The Rational Perspective, this morning will see that I've really been thinking long and hard, given the way that retail investors have been coming into stock markets and believe themselves to be bulletproof. You only have to have a look at the Wall Street Bets string on Reddit. It's very easy. You can access it. Just go to reddit.com and look and just type in there Wall Street Bets, and you'll see the kind of people who are populating that forum. And the punts that they've been taking are people who really should be far away from the share markets. But they aren't. They are playing. They are likely, it's likely that their efforts are going to end in tears, but it's a reflection of. And when that happens, all news that comes out tends to be interpreted as positive news, but then the interest is lost very quickly as well. So that's what's happened with Xero. I'm quite happy, as you should be, that we now managed to buy 133 Xero shares in the second tranche, after only being able to buy for the same money 120 Xero shares in the first tranche. And hopefully the share price will weaken still further, and maybe we'll buy 140 Xero shares for the same money in the next tranche of purchases. But we buy it over 3 months, and it's a very good idea to do that. Here's a graph that I want you to have a look at very carefully. I've gone back here in the past month, as you can see, from the 25th of January to where we are today. And the Rand against the US dollar, the Rand appreciation against the US dollar is the blue line at the top. You can see it's around 4%. The Rand appreciation against sterling is the orange line, that's under 1%. And against the Aussie dollar, which I threw in there just to give you a better understanding, is also around 1%. So it's not a question of Rand strength, it's a question of dollar weakness. And that has had an impact on our portfolio. As you can see, we were sitting at over 11 million, comfortably over 11 million in the end. Well, the last time we did the portfolio in January, the Rand impact alone, the appreciation of the Rand alone during this period, has taken 450,000 Rand off the Rand value of the portfolio. But even so, the rise since the pandemic began has been extraordinary. We're up in the past year by 59%. We're helped along there by Sasol, which we bought very cheap at 28 Rand and then sold at 140. I guess that was premature. If you'd held on to those Sasol shares, you'd also be looking pretty good now with them around 200 Rand. And it also is a consequence of the Discovery shares, as you can see there, up 163% in dollars and 121% in rands, the purchase being made at absolutely the right time as far as the pandemic is concerned. So the pandemic has been very good to us, or good to this portfolio, because we bought a lot of stocks which have done very well at the bottom of the market. Moving on to what happened in the past month, you can see there the JSE shares were the ones that did best. Discovery up 16%. 2U, which I can dwell on a little bit later, their results came out very strong. Also nice results from Spotify. On the other hand, buy on rumor, sell on fact happened with Apple, and generally speaking, a decline in the US stocks. Cloudflare down by 5%, but that's bouncing all over the place. The portfolio value was down by 5% in rands, and you can see there it was a decline of about 4.5%. An appreciation of about 4.5% in the Rand against the US dollar in the past month. In dollar terms, our portfolio was, pretty static, from $739,000 to $735,000. Remember, we started this portfolio in 2014 with $200,000. So it just shows you when you get these high compound annual growth rates, in other words, you're growing money on money, or you're growing from profits already made, it really does surge. So $200,000 in December 2014 is now worth $735,000 in February 2021. I think anyone would take that. Individual performers pulled up there by Amazon.com. As you can see, That's our 10 bagger. But we've also had some good performances really from most of the US shares and Discovery by buying it at the bottom of the market. The 2U is now broken into profit. The only one that is negative for us is Wilson Bailey. And the reason for that was there was quite a lot of heat in that 110 Rand share price because of an anticipated sale to Chinese of Wilson Bailey's Aussie operation, which is about 50% of the business. So what is interesting about this table is that in 6 years, more than 6 years, the Rand has depreciated in total by only 30% against the US dollar. Interesting, isn't it? We have this perception that the Rand is a very weak currency and that it's going to get killed by the dollar over a period of time, but only a 30% depreciation, which would suggest to you that there might be some correction in that coming soon. There's individual stock performances. I love putting this up so you can just see how Amazon has been an amazing performer for us before we start getting too clever and saying, you know, how smart the stock picks have been. Just look at that. Amazon has been absolutely extraordinary. But the real story here is when you look down the bottom at the Rand dollar, that has appreciated by less even than our Naspers shares. And that tells you, or that it's not really a fair comparison because it's Rand dollar going back to 2014, whereas Naspers was bought much more recently. But it also shows you that if you just taken your money and put it offshore and put it into money market instruments in the hope that the Rand would depreciate against the US dollar, you wouldn't be feeling very happy today, or certainly not as happy as the people who invested in equities. Okay, January star performer ahead of results. I showed you this graph last month here where 2U went very strongly because of an anticipation that the financial results would be good. You could see it was under $35, got to almost $45. And then the numbers came out and they were exceptional. And the share price in the past month went all the way up to $55 a share. Just to really elaborate a little bit on that, what we have here from 2U's perspective is that we do have a company that is growing. It's got lots of cash in the bank. It's also got free cash flow, which has now got to the point where the operating of the business is virtually at break even. So it's got more than $500 million in the bank, which could be used to pay for growth. But with a company that is growing so rapidly like this one, 2U, of course, is a very focused online tertiary education business. So what it's doing, I'm just sorry, it looks like we might have just lost that graph.
Your presentation again, sorry.
Mark, there we go. Okay, apologies. You know what I did, Stu, was because the internet has been a bit dicky here, I just wanted to make sure that you were still online, or that I was still online. So if I go offline, just ping me, please, on Slack. So, yeah, okay. All right, anyway, so there it is. There's, you can see the graph now. Just go into it a little more. There we go. Are you happy with it, Stu? You can see it?
Alec, it's fine. It's just not the usual presentation. It's showing us the whole, it's not a problem, the whole PowerPoint on a system, if you know what I mean. Not the slide itself, but all the others on the side as well.
You see, now if we were in the same room, it would be so easy, wouldn't it? Okay, let's try something. Okay, you know what I'm going to do? I'll play around with it in a minute.
There we go.
I just wish I learned. I wish I could learn how to put onto main screen. Okay. I wish I could learn how the Apple thing works rather than having to rely on PowerPoint all the time. It just seems like PowerPoint always gives us a problem, but there we have it. So that's the graph from last month. From this month, right? From the last month in February. As you can see, was the, let me just try and go back one. There we go. All right, that was in anticipation of the results. When you can see that share price down below $30 in December, somebody got wind of the fact that 2U was going to produce good results. So it's under $35, goes up to nearly $45. And of course, the results come out. They are exceptional. This company is really, really pumping. And Mr. Market goes nuts. He takes the share price up to $55 a share. Maybe we bought at 38, so we're looking happy. And then he loses interest. And he's been losing interest over the next few days. So what this tells us is that if you've identified a stock that you want to own, then please don't buy it when everybody else is rushing into it. Discipline yourself, as we're doing with Xero, to buy over 3 months, because you would then eliminate the insanity that Mr. Market often brings to bear when we're talking about equities. Okay, and there's the portfolio today. As you can see, only the 2 shares that have underperformed. And in dollar terms, Wilson Bailey's only down 6%, which is not a problem. You don't have to worry about Xero. We are in the process of buying the stock at the moment. So we're in fact, we want it to be negative because we want to try and buy more shares into the future at a lower price. And that's the presentation. I know quite often what happens in this presentation is that we have many questions and we never get through all the questions. I see we've got a few hundred people on the webinar today. So hopefully, Stu, we can get those questions sorted out this time.
Excellent, thanks, Alec. I've got a few. So yes, I do encourage people to please send some more. I've got 3 or 4 at the moment, Alec. Just quickly from Miles, he wants to know, what are your views on PGM shares given the increase in prices of platinum and rhodium due to demand outstripping supply?
Miles, it's actually the hot topic of the moment. Interesting, isn't it? I mean, we sit here in South Africa where a big chunk of our market is in mining. We get terribly excited when we see that commodity prices go up, and rightly so, because that means that South African companies are making a lot more money and there's more money flowing into the country, et cetera, et cetera. So the big story though at the moment, and where PGMs are also benefiting, but not totally, but is the battery story. We saw this morning actually that Sibanye has now positioned itself for going into those minerals and metals that are used in electric cars. It's almost like Mr. Market has got the electric car bit between his teeth, and he's rushing off valuing or excessively valuing anything that produces products for electric cars. It's interesting, if you search Biznews of a few years ago, Ivan Glassenberg, the South African from Joburg, who built Glencore to a large degree, who's now stepped down as a CEO of Glencore, at an annual report a few years ago, he said Glencore was refocusing itself to becoming a battery mineral player. So he saw the light long before everybody else. Indeed, his old adversary, Sir Mick Davis, you would have read from the newsletter this morning. Mick Davis is from PE, Port Elizabeth, and he was in fact, he was in his 20s. He was the financial director of Eskom back in the days when that actually meant something. Mick Davis is a brilliant man. Recently was the chief executive of the Conservative Party in the UK. And with Xstrata, once that was merged into Glencore, he then left and started another business where money was just thrown at him to go out and make some investments. But after a period of time, I think it was about 2 years, he discovered that he couldn't find anything right back then which actually offered value. So he gave the money back to shareholders. How often do you see that? Certainly not often enough. Now, however, Sir Mick the Miner, as they call him in London, has identified batteries or battery metals and minerals as being the next big thing. So he's now raising money again, and he will be investing into that area. It'll be nice to follow Mick Davis, no doubt, but you do have the options already on the market. Sibanye moving in there. Neil Froneman is extremely shrewd when it comes to identifying the best prospects for his industry. He's a very good miner, and you could probably add Sibanye if that's the play that you like. to your portfolio. I haven't looked at the share recently, and I haven't seen what the valuations are, but maybe don't add it to your portfolio, but add it to your list of companies to do homework on. You can also do that with Glencore. And why am I saying this? Because I always mention in this webinar, and for years we've been saying the same thing, stay away from inanimate metals because you want to invest in human ingenuity. But if commodities are being managed by ingenious humans who are looking to take advantage of the seismic shifts that are happening in the economy, then there's nothing wrong with applying that philosophy, if you like, to certain shares that you might like. As far as we're concerned, we're not going to buy Glencore. We're not going to be buying even Sir Mick Davis's company. We will be sticking with exponential companies, those businesses primarily driven by technology, which are growing as a result of the massive shifts that we're seeing in the world, where the world digitizes. Some sectors very rapidly, other sectors a little more slowly, but they're all digitizing. And that's where we've focused our attention, with the sole exception of Wilson Bailey, which is a South African play on infrastructure.
Thanks, Alec. There's a question from Chris. He says, I'm new to the webinar. I'm interested that you have not taken a position on any Chinese stocks yet. Is there a specific reason for this?
Yeah, Chris, in the past, we did have direct investments in both Tencent and Alibaba. Then we had Donald Trump, and at the time, the fundamentals were really changing. It was quite a volatile period for both of those stocks. We took a view that as the underlying fundamentals in both of them had altered, it wasn't really, if this is a portfolio where you want to go to bed at night and sleep and know that the underlying asset that you have is one that you don't have to worry about. I'm still not keen on Alibaba, and I think if you followed what happened with the Alipay listing or proposed listing, it was supposed to be the biggest listing in history, the biggest IPO in history. And 2 days before it was due to be listed on the Hong Kong stock market, the Chinese authorities showed their muscle and actually aborted the listing. It caused all kinds of embarrassment for Jack Ma, the founder of Alibaba, but it actually showed that in China, this arm wrestling that's going on between the Communist Party bureaucrats and the entrepreneurs, it can always be won fairly easily by the bureaucrats. And when the entrepreneurs overstep the mark, they are brought back to heel. Now, that's not a good place to be if you're an investor, because you just don't know what is going to happen in a autocracy like Communist China is. I keep reminding people that this webinar would not be possible if we were in China. Neither would Biznews be possible, because if you're in the media industry, you need to have a censor sitting in your newsroom who decides what you will and will not publish. So it's a very, very different country to the one that we live in, thankfully for us, where we do have the freedom of speech and the ability to explain what really is happening and speak truth to power. You speak truth to power in China, you know that sometimes people just disappear. So that's one of the underlying issues that concern me about investing in China. However, we do have Naspers in the portfolio, and Naspers is still trading at a discount of about 50% to its underlying investment in Tencent. Tencent has also had its problems with the authorities. A senior executive of Tencent disappeared recently after a issue that the bureaucrats weren't happy about. So it's not that they're immune, but Pony Ma, who's the founder of Tencent, does seem a little more astute in managing both his profile and his engagement with the Chinese government than Jack Ma from Alibaba. But generally speaking, China is a very, it's the kind of risk like a Tesla. When you invest in Tesla, you believe Elon Musk is a genius. I don't think it's difficult to disagree with that, but it's also a very volatile company and a very volatile stock. So China is similar. The risks are extremely high. So this portfolio has been built on the basis that you can see some kind of a runway for the growth into the future, given the international changes. You'll see that we don't have Google and Facebook in the portfolio. And that's another reason, because the world is changing for those two companies. We had a big announcement coming out of Australia where the Australian government is forcing Facebook and Google to actually pay the media companies which give those two businesses a lot of their growth. And Facebook, in fact, has come to a settlement with the Australian government after initially saying it refuses to do that. Now, what that means, the knock-on effect for the business model is massive, because if other countries pick up on where the Australian government has started, the margins at those two businesses are going to be severely impacted. And when you consider the United States is no longer an arch capitalist in the White House, but someone who's perhaps more socially minded in Joe Biden rather than Donald Trump, then you have to wonder whether what we've seen happening in Australia isn't going to come to the United States. Of course, both Google and Facebook have been mentioned, not glowingly, by the Democratic Party dominated antitrust committee last year, which wants to do lots of things to contract the power of big tech. So all of these things affect you, and I don't want to wake up one morning and hear that something that I own, a company that whose shares we have in our portfolio, is suddenly halving because of some bureaucrat's stroke of the pen. And I guess that's the issue that I have with most of the Chinese opportunities. Yes, they're great opportunities, but the political system there is not one that should be inspiring free enterprise protagonists with a lot of excitement.
Brian just wants to ask your thoughts on ETFs, primarily Kathy Wood's ARK Invest. Alec, I'm not sure if you have any thoughts on that.
Well, she's the superstar of the moment, isn't she? But I don't really want to, I won't mention a name, but there was a portfolio manager in South Africa during the dot-com boom who wanted to buy shares in MoneyWeb, which I listed. And the more shares I could give him, the better. He was running a tech fund at the time. He was the star of the show. He'd cock a hoop. And during the dot-com bubble, money was just flowing into his fund so rapidly, he didn't know what to do with it. He was the guy who couldn't get enough shares at a rand, and he was the man who actually sold them at 17 cents within a year. So fame is fleeting in the investment market, especially when you're working on the margins. And I guess Kathy Wood's ETFs, after Tesla's down from 880 to 700 in the course of a week, will not be looking quite as good as they were a week or so ago.
Thanks. Just a follow up on Tesla. I know we sold out. Someone wants to know, just at 700, is it time to add, or do you still think it's too volatile?
No, I think if you believe Elon Musk is a genius, and I think we all do, if you believe that he's got a jump in electric cars, then you've got a basis for starting to analyze the stock. But remember that price is what you pay and value is what you get. So would Tesla be cheap at 1,000 Rand a share? Well, clearly not. Would it be cheap at $1,000 a share? 1,000 Rand would be very cheap. $1,000 a share. Would it be cheap at $10 a share? Of course it would be. But you need to actually work out your own intrinsic value. And that's what I keep banging on about. If you have a look at a company that you want to own or part own, because that's what you do, even if you only buy one share in Tesla, you're a part owner, then you have to view it in the same way as any other company that you might acquire or buy into. You're now a part owner. Are you prepared to buy the local corner cafe, although there aren't many of them left, but just to use it as an example, for R1 million or 100 million Rand? Clearly, somewhere between the two might be the correct price. Whereas what we're seeing on the market at the moment is that corner cafes type investments, if they are digital and they've caught the imagination of the Reddit crowd, will be 100 million rand plus. So I think that really puts it into perspective. Don't get caught by the crowd. Have a look at the business that you're buying into. If you had bought Amazon at the absolute peak of the dot-com bubble, before it dropped by 97%, okay? So you bought it, it fell to 3% of its value. You would still have made a fantastic return by holding on to that company's shares today, a multiple of a 10-bagger return. So as long as you're prepared to do the homework, find the stock that you really like, understand that Mr. Market is a manic depressive who's going to send that share price all over the place, and especially during a period like we're seeing right now, where interest rates are pretty much zero in the United States. So you can borrow any money you want and have a punt if you don't have a job or whatever it is, a bit like what happened with the housing bubble in the United States. But is the underlying company that you're investing in sufficiently grounded and strong and growing its base that you can sleep at night? You know, I did some work on Amazon, and I am worried about Amazon. It has done a phenomenal. It's our 10-bagger with Jeff Bezos now moving up to executive chairman and replacing himself as CEO. Then there a few of the other things that are worrying me about Amazon is that Democrat Party antitrust committee that now that the Democrats rule all fields in the United States is going to be more powerful. It's going to come that they're going to attack the companies that are apparently or perceived to be too big, just like they did in the 1920s with John D. Rockefeller's Standard Oil. Similar thing coming. Now, would that affect Amazon? Would it knock Amazon's share price heavily? Are there fundamental reasons why Amazon is overpriced? Those are the questions that I keep asking myself. And at the moment, I can live with it, because at zero interest rates, where are you going to put your money otherwise? But when it comes to a stock like Tesla, you really are discounting perfection and a lot more on top of it. So I like to sleep at night, and I think that's really, it comes down to the valuation that you make, the intrinsic value you have for a company. And that's why we sold Tesla. We sold Tesla at a fraction of its current price because it was starting to get too volatile. Elon Musk's behavior in 2018 was eccentric, to say the least. And as a consequence of that, with the share price bumping up and down and short sellers getting involved and him fighting with the SEC, it just wasn't the kind of stock that you could go to sleep at night and know if it were to drop by 10% tomorrow, you'd want to buy more. It just wasn't that kind of a share.
Excellent. Thanks, Alec. Kirsten just wants to get your thoughts on Discovery. She says it has run hard. Would you still consider it a buy at this level?
Kirsten, yeah, I think the point about companies is the getting back to doing an intrinsic value valuation. First of all, the length of time that you own the stock should be forever. Now, these are not my ideas. This is I've done a lot of work on understanding what Warren Buffett, what made him the greatest investor of all time. He's a heck of a lot more cautious than we are, because he does not invest at all in tech companies. He wants to see a runway of 10 years perhaps before he would be sufficiently confident to buy into certain shares. The motives that inform the decisions of this portfolio come from my career in digital media in the one hand, but I suppose the digital environment generally. So when you have a look at that, when you start from that basis, you do look for growth and those kind of companies, exponential companies we call them. When you look at Discovery, we must not be distracted by what's happening in South Africa. On the one hand, it is still the biggest part of the business today, and the investment that they're making in the bank might take a heck of a lot longer than the brains trust that Discovery think it's going to take to actually achieve the goals that they're aiming towards. In the UK, something like 99% of people who bank there will never ever change their banks, or certainly won't change it in 5 years. We're similar to that in South Africa. The hassle factor of moving from ABSA to Nedbank is so large that unless ABSA really abuses you, you wouldn't even contemplate it, and vice versa. And into that market, Discovery is applying its wonderful added value or shared value concept, really. So you bank with them, you do better because you get the Vitality miles or points, you get a higher interest rate on the bank, and so on. So it's got a better chance than most to push people across from one bank to the other. But the inertia is something that you cannot underestimate. But that's South Africa. Where the Discovery excitement is for me is what it's doing globally. It has a partnership in China with Ping An Health, which is growing like topsy. And you have to realize that China, for all its economic might, is still way beyond the top 50, way outside the top 50 in per income per capita in the world. So it's got an enormous amount of growth still to do, and its people, the 1.3 billion people who live there, have got a lot of appreciation in their wealth, certainly per capita, to come. They work hard, they are enterprising, they have a government that somehow they work around, and that government thankfully says they don't care what color the cat is as long as it catches mice. In other words, the free enterprise system up to a point, and when you're not threatening the Communist Party, then they give you a lot of leeway. So Ping An is growing like topsy. Discovery owns 25% of that. And that is a fantastic investment, a little bit like what SAB Miller, the investment that it made in Snow Breweries all those years ago, which transformed SAB Miller. If you have a look back at that, unfortunately, of course, it became part of AB InBev, but that's another story. It was because of its Chinese operation actually on the table, and it did attract the interest of those multinationals, and eventually shareholders did very well out of it. But getting back to Discovery, China is a big story. Europe is a big story. Asia generally, Southeast Asia with AIA is another big story. Vitality, which is the UK operation, is a huge story because British have their national health. But the national health has been, well, having to focus on COVID and the pandemic this time around. So unless you've got a Vitality product or a similar private health insurance, and you have something other than COVID as a malady, you really weren't going to get a look in. So there's a view in the UK as well that this is a very good thing longer term for Vitality, because you can't just rely on national health in the UK, apart from its other challenges too. And Vitality is well positioned there, got excellent management, and it's another extremely good business arrangement there. They have operations in Europe and in the United States. And the most important thing I think about Discovery is not what's going on in South Africa, but it's the global environment. And if you work that into your intrinsic value at 147 Rand, it's still incredibly cheap.
Thanks, Alec. Ronald just wants to know, do you still look at Richmond? And if so, what's your take on it at the moment?
Yeah, I do. I keep an eye on it. I think Richmond is highly conservatively managed, and that's not a bad thing in most circumstances. It's also invested heavily into the online field. So Richmond's future has, they've got a big bet there on online. What worries me about Richmond is that Amazon is moving into that market as well. So it's gone quite aggressively into the luxury end. And everywhere before, every single instance in the past where Amazon has targeted a particular sector, it tends to dominate. You can have a look at even groceries in the United States, where it targeted and then acquired Whole Foods and is now just growing market share. It's very hard to compete with Amazon. And maybe the luxury goods area where Richmond has invested heavily is going to be the exception, but it does come with a lot of risk.
Thanks, Alec. Jack just wants to know, he says, you discussed Tongaat as a possible addition to the portfolio a few months back. Do you have any current comments on the sugar producer?
Jack, again, great management. The team that's gone in there has done a phenomenal job. It often happens that when there is another team ensconced in a company for an extended period of time, that certain things are forgotten and they aren't perhaps as sharp as the attention is not as sharp as it should be. In Tongaat's instance, we know that there were a lot of accounting shenanigans. Deloitte's in trouble over there. Peter Stader's in trouble. It's been well documented, and there's no point in raking up old coals here. But with the new team that is in there, with Rob Aitken, the financial director, and of course the chief executive, Mr. Hudson. What's his first name, Stu?
Sorry, it's Gavin, Alec.
Gavin, there we go. Sorry, Gavin, I apologize. He's actually been one of our, he was on a webinar, on a Monday webinar with us, Gavin Hudson. But great that you forget his name, because that's what you should be doing as a chief executive. You don't want the guys on the front page of, Business Week magazine and all over the radio. You want them to be working and getting on with their job, and that's what Gavin Hudson's doing. However, when I look at Tongaat, although the rebound opportunity is there, it still carries a lot of risk, because I'm not sure about sugar. How can you really put an enormous amount of your wealth into buying a share in it, or a part of a company which is invested in a sector which is in the crosshairs of just about every mega trend that we're seeing at the moment? The wellness mega trend is very anti-sugar. We have a sugar tax in South Africa, and we're a developing country. So you think about what it's going to do longer term in the Western world, and you can't be filled with great inspiration. However, there's a huge turnaround prospect, and
Alec, are you still there? Apologies, I think we lasted 47 minutes on the hotel internet. Let's see if we can get Alec back quickly. Just trying to see if there are any of these questions I can answer while we wait for Alec. Sorry about this, everyone. I see they are all targeted at Alec. If I can't get Alec up, I'll keep the questions and we'll try contact you people, each individual separately. But let me just give him a call quickly.
hello.
Chat now.
I'm back. Okay, you can hear me now, Stu?
Yes, sorry, I was just trying to phone you, Alec. All good. I did try to handle the questions, but unfortunately, I don't have the same insight on some of the topics. So, yeah, all good.
Well, anyway, I'm back on the iPhone now, so it should be fine for the last 10 minutes or so.
Perfect. Just quickly from EJ, Alec, are you still considering Afrimat and Italtile?
Yeah, they were goodies, eh? Gee, both of those were stocks that if we'd gone into rather than Wilson Bailey, we'd be looking a lot smarter than we are today. Both good companies, and both companies that if you owned them or you went and bought into them, stay with them. Nothing wrong with those. I'm looking now for exponential companies. The ones I'm looking at right now are Signia, because the exponential potential there for the growth in ETFs, as people become more more au fait with the internet and understand better about investing and want to take more responsibility for their own investing. That's got to help Signia, also a very smart management team that's there. And I see from the recent media reports that Magda Wizikcha is going to be bringing a whole lot of new products in. So she's very excited and very optimistic about the future of Signia in the future. So have a look at that one. And I really, really, really like Purple Capital. It is one of the few exponential companies in South Africa. It's not the focus of our partners at WebTrader. You can't, for instance, go into Purple Capital and put or Easy Equities and put a stop loss in. You can't put an order in at a particular share price. There are many deficiencies relative to a full service stockbroker. However, the fractional investing story is very exciting around the world, and they have it here. They've also moved recently into Australia, and I'm sure that's not the last geographical expansion that they've got. Fractional investing is a very, very exciting area, and they've moved into using their base. They've moved into even selling properties, and they get sold out within a few minutes. So it's not an either or. Standard Bank WebTrader is very much focused on maybe this more sophisticated investor, whereas Easy Equities is going at the lower end of the market, and it's been extremely successful. Their deal with Capitec is off the charts good. Hundreds of thousands of new accounts opened, and the Capitec base is millions of people who worried about the cost, and they're also worried about their future, so they need to invest. So that relationship for Easy Equities has not yet been reflected in the share price of Purple Capital as it's listed on the JSE. So those are the two I'm looking at. I can't get my head around the intrinsic value yet of both of those, but I'll get there. And I guess if you're looking for to do a little bit of homework, those would be two that offer great potential.
Thanks, Alec. Ikhshan just wants to know, he says, obviously the portfolio's done very well if you started it in 2014. Are you thinking about a new portfolio?
Yeah, it's a very good question. I suppose it's nice to be able to look back and to say, even if we have a bad run now, the performance of the past is going to make it look pretty good in the future. That's not really the purpose of it. I think it's a good point. It is something that I've been thinking of. There is a sunset period for every single portfolio. If I were to change the portfolio today, how would it be changed? I suppose that's the biggest question. And on that, I'm not really sure. I'm not sure whether, and there's the portfolio on screen now. I think it's quite obvious that at 22%, it's a bit heavy on Amazon and 18% on Apple. You got 40% of your portfolio in those two. But those of you who were with us right from 2014 will remember that we had 40% of the portfolio in the two bankers back then when we began, and the bankers were Berkshire Hathaway and the S&P 500 index. So it's not too dissimilar there. And then there were a group of the rest of the shares were all at 8%. Now, if you look at this, we've got Adobe Systems at 8, we've got Microsoft at 8, but Naspers a little over 8, Netflix virtually 8, Discovery at 8, and if you add the others, what's left there, Spotify, 2U, Cloudflare, and Xero, they'll make the other two up to 8. So it's quite nicely diversified as it is now. The intention on this portfolio, though, is to continue to have a look at it to make sure that you're not out of kilter in the future projections. And it really isn't to say to you, now go and use it and replicate this portfolio exactly. It's more a question of saying these are the shares that we at Biznews have done a lot of homework into. These are the ones that we're confident that you could buy and hold for the long term and do well out of, rather than let's go and punt Xero and double our money in a year.
Thanks, Alec. Malcolm just wants to know, is it not a good time to start adding to WBHO? Just you mentioned the current run.
Yeah, good call. I did suggest when it was in the early 80s that it was cheap. To me, the intrinsic value is far north of where the current share price is. So if you do your own calculations on intrinsic value, then I think you're going to come to the same conclusion. It's probably worth accumulating, yeah. But remember, this is not a typical share for this portfolio where we look at digital or if you like, new age companies that are benefiting from the move away from the physical world to the digital world. And those are exponential companies, and those are the ones that, like Amazon, if you'd bought it at the peak of the dot-com bubble and you turned around in 20 years' time, you would have made a multiple on your investment. With Wilson Bailey, it's got a runway, but it depends hugely on South Africa getting its act together.
Thanks, Alec. Peter just wants to know, it might be a nice one to finish with. He says, hi, Alec, there is a lot of talk about the coming crash. What is your view?
I've also been thinking a lot about it, and obviously been influenced by these really smart people. Granville, excellent interview that Jackie put onto our Spotify channel a couple of weeks ago, who's convinced that the market's going to crash. At the end of the day, my conclusion to this was the only one that a rational person can come to, and that is that you have three areas to invest in. From a long-term perspective, that's in money, in other words, in interest-bearing investments. It's in property, and it's in equities. So those are your three major investment prospects. Yeah, some people say, oh, well, Bitcoin is a great place to go, but those same people in the past week are probably feeling pretty sick right now if they happen to have bought it in the past week. These are, when you're buying as a co-owner of a company, you are making a bet on the management of that company, the human ingenuity, and if that company is not constrained by being in a bad sector or a sector that isn't growing, like for instance Wilson Bailey's got excellent management, but my goodness, I don't think anybody could make money or good money in construction right now, certainly not in South Africa. The future hopefully is going to be different. That's why we like it. But on all these other shares that we have in the portfolio, they've all got great management teams, they've got great ideas, good energy, good enthusiasm, and they have runway in their businesses. And I'll just point you to 2U, which is the global leader in tertiary online education. Xero, the global leader in accounting, online accounting packages. Cloudflare, the dominant player in internet security. And these are relatively small companies still. Spotify becoming increasingly the dominant player in podcasting, which is the next, well, it's audio on demand. Netflix, the dominant player in video on demand. And you can go through all of them. Adobe Systems, the dominant player in its areas in software. We've all heard about PDFs, and now suddenly everybody's using PDFs, which is an Adobe product. And it goes on and on like that. Those are the kind of companies that you want to invest in, you want to keep an eye on, you want to be sure that you're not going to, that they aren't making a misstep, and that you can't sleep at night, because no matter what happens in the long term, you'll wake up. If the stock market was closed for 5 years, as Warren Buffett keeps reminding us, if you close the stock market for 5 years, would you be happy to own the shares you have in your portfolio? Right now, of the shares in this portfolio, there's not a single one that I wouldn't be happy would be worth a lot more money in 5 years' time. I hope that helped.
Excellent. Thanks as always, Alec. I think we can end it here. And thanks for your time from Cape Town. I know you're going to be very busy over the next day with budget, and I'm sure everyone listening will look forward to your next webinar tomorrow, as we are overloading you with the webinars this week.
Yeah, let's not forget about that before we got the one tomorrow, and then we've got a very interesting webinar coming up on Thursday with Tim Modise on security, internet security. It might seem an arcane subject, but it's actually very, very important as well. Yeah, tomorrow night, 7 o'clock. I think the connectivity is going to be okay. Certainly, it's been fine now with the iPhone. Thank you, Steve Jobs and Tim Cook. Switching across from the fiber to iPhone worked really well. And I look forward to being in your company tomorrow. I'll be up bright and early, going to the lockup, which is the way it works, is that the Department of Finance, the Treasury, actually open up all the minister's documentation to journalists who then get locked up ahead of the budget speech. And what I do then is work through the information, do a lot of preparatory work for it, which I'll be doing in the course of the next 24 hours, and then put together what I can, send it to Stu and the team in Johannesburg, and they are allowed to get it from 1 o'clock. They then process it, put it on the site, and at 2 o'clock tomorrow, immediately as the minister starts talking, as Tita starts talking, they publish it. So you can go onto Biznews tomorrow around 2 o'clock, and you'll be able to read all my efforts, or the fruits of my efforts. And then tomorrow evening at 7 o'clock, as we always do on budget day, thanks to the sponsorship of Bright Rock, and they sent me here to Cape Town on a magnificent day. I must tell you, it is beautiful here in Cape Town in February. Wow, and the sun is shining. It's just special. But at 7 o'clock tomorrow night, we'll have a webinar. I'll do a small presentation and field questions. It's the most important budget we've had, I think, probably ever. So let's hope that we'll have some kind of a cohesive response from Biznews for our community, which is you. Thanks for being with us, and look forward to being in your company tomorrow. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.